Oil prices falling for a second day amid some discussion that perhaps at $120 a barrel for Brent crude, oil prices are starting to crimp off demand in the global economy. We're joined now by Dan Dicker. He's a veteran oil trader and the author of Oil's Endless Bid. Dan, have we finally maybe hit the limit of what the global economy can sustain in terms of oil prices?
Well, I don't think so, but there's been a couple of at least short-term dents put on the idea that oil is a straight-up ride. One from the Saudi minister Al-Naimi, who said, there's really no place to put anymore. I mean, we have an enormous supply surplus going on globally, and that, in fact, they're going to cut back production. Now, that's kind of an interesting viewpoint to take at $122 Brent prices.
Right, but you would think that oil prices would have risen on that news. So
in fact, I think they will. I think that the first reaction is going to be exactly that. Oh, there's plenty of supply. We're going to leave the market for a short term, but in the end, what will happen is the global marketplace, as they always do, will get suspicious of OPEC and its members, say that they're just kidding around, they really don't have the oil to supply,
right.
And in fact, the peak oil arguments will start gaining some strength, and again, we'll see another rush up.
So what do you think happens, really? Because 2 years ago or 3 years ago, we saw oil here. Everyone said, oh, it's just a panic. Then it went down. We all forgot all about it. Here we are again. Is this just the trend going forward?
Well, here's the problem, Henry, and here's what I point out in the book. If oil is no longer really a function of supply and demand, if it's not a measure of fundamentals and it's only a measure of financials, then in fact only financial events will have an ultimate price impact on oil. Now, we saw that in 2008, 2009, when in fact the entire deleveraging of all asset classes brought oil down from $147 to $32 in 8 months. Now, we're now in the midst of what I think is another boom-bust cycle in oil. So the question is, what financial event is going to drop oil's price this time around? I hesitate to think about it.
Is it Goldman Sachs saying maybe the commodities boom is over? I mean, that was basically their message last week, right?
Well, in fact, what was interesting about that is that they had a note 2 weeks prior to that saying that the speculative premium in the oil market wasn't enough, that in fact it was only about $10 and they really expected it to be more like 30. And then they brought out another note. You could get suspicious about these notes and what the oil market does after they bring out these notes, because they bring out a note, first of all, that maybe there's not enough speculative premium in it. Oil rallies about $12, and then they bring out a note, well, maybe we should, catch a little bit of this profit here, and oil drops 4 or more like 6.5 over the course of 2 or 3 days.
So you make it sound like it's all financial, trading, speculating that's driving oil prices. Isn't it true that our demand for oil worldwide has gone through the roof in the last 20 years, yet we have a finite supply of it? I mean, doesn't it make sense that oil prices are going up?
And it's tough in a segment to try and debunk some of the peak oil arguments and supply-demand arguments. What I can say in the short, for a short response, is that for the most part in the past 20 years, demand has been met rather easily by supply and has been over the last 5 years by some very new technologies that we weren't able to do. Even 5 years ago, for example, ultra-deep water drilling, which has in fact found a couple of enormous loads, not only in the Gulf of Mexico, but outside Brazil. Precisely. So these are reserves that we didn't even know we had a while ago. There's talk about oil shale. There's talk about oil sands. Of course, it's a finite resource. In the end, it runs out. There's no doubt about that. But new reserves and new ways to get at them seem to be coming up every now and again. So the supply side argument to me is a little bit suspicious.
Right. So you write that there's been seismic changes in the industry of oil trading, and you're an oil trader. Like, what's changed so dramatically? And do you feel like, hey, I'm part of the problem here?
Well, I mean, we're all part of the problem. I'm not much of a moralist when it comes to trading. I mean,
you're there to make money.
Right? Yeah, that's correct. Right. But the point is, that when I first started in the business, the people who were engaged in oil were those who were physically connected to oil companies, people who used oil as end users, and then there were a couple of guys like me who were trying to sort of match trades between these two. Now, that was overrun at the turn of the century, and particularly in the last 5 years, by the financial players: Goldman Sachs, Morgan Stanley, J.P. Morgan, Bank of America, Citi, Paribas. I mean, the list goes on and on. Prevon, Glencore, the old Mark Rich company, Vitol. I mean, the list just goes on and on. Very few of these people have any interest whatsoever in the physical aspect. No interest, almost zero interest in hedging anything. It's all about the trades. So clearly, the financial players have overrun. They've swamped out the physical players.
So bottom line, What's the average oil price the next couple of years?
Well, I mean, again, I see these kind of boom bust cycles being part of the mechanism now, and I don't know what kind of gets us away from that. So what's the bottom line? I don't know. I think what you'll see higher highs and higher lows, but you'll see pretty significant swings. The volatility will only get larger. And for this last one, you saw 147.32. Maybe this one you'll see 130.75. The next one you'll see 175.110. The next one you'll...
But the trend is upward.
No question about it.
All right, Dan. Thanks very much.